Oh, hey, everybody. This is your old buddy Romulus. You caught me at the beach. Well, that's what I like to do when I'm not trading, hanging out on the beach. And you know what? Your old buddy Romulus gets to do that quite a bit. When you trade with low time commitment ideas, highly efficient trading styles, with large percent winning ratios, well, guess what? You get to go to the beach like I do. That's right. Hopefully you'll join me in the near term. Again, this is Romulus with Backpack Trader, and thank you for giving me another opportunity to spend a little bit of time with you in your valuable afternoon to talk about the markets, and it continues to be one wild and crazy affair out there. Microsoft comes out with earnings late yesterday afternoon. Stock is trading well. Google also came out with earnings late yesterday afternoon. Stock is not trading well. Market's experiencing a bit of a rebound in here. That makes sense when you look at how oversold the stocks became on a short-term basis. And there's a little bit of that positive divergence. You see that right there. So that gets us to a position where the market kind of sets up for a bit of a rebound. Could it be lasting? Could it be loving? Could it be something that we can take to the bank, baby? Probably not. No. A day, a week, a month. Maybe a little bit longer. Doubtful, though. Maybe a little bit longer. But keep in mind, go back to every video that I have posted on the Backpack Trader site since joining up here about 5 weeks ago. Every single one of them shows the same thing, talks about the same thing. As the markets were rallying, I kept repeating that the highest probability outcome was between then and the end of September, markets would come down and revisit these lows. Hey, look, what I thought was going to happen in months only took days. Well, in bear markets, sometimes them's the breaks. That's all there is to it. However, let me talk about why I expected the market to come back down to these lows. And if you look at some of the indexes, here's the Russell 2000. Below them, let me get rid of that. Here is the communication sector below them. And now even the financial sector has gone below these lows. Wow, that just happened earlier today before the little bit of a rebound started to kick in. I've got some purple lines on the chart. Being an ancient Roman, I love the color purple. When you have a toga that is bordered with purple, oh, that means you're somebody. So I've got some purple lines up on the chart right here. This is the S&P 500. It's going higher and higher from early November into the early January all-time high. You see the indicators, though, they're going lower. You see the purple line? It's going lower. The prices are going higher. That, everybody, is called a good old-fashioned negative divergence. And when you see a negative divergence, it is reason to put up your guard. It is reason to remember the four-letter word. No, not that one. Risk. That's 4 letters, R-I-S-K. It is reason to become a little more cautious. And it's one of the reasons, even though it was a couple of months later, that as the market started rallying from those early and mid-March lows, I was highly suspicious of the rally and fully expected a retracement back to those points, which we did get. Fully, 100%. Again, my only misread was that it took days instead of months. Another reason why I expected to see a retest of those lows, boy, I'm all kinds of informative today with these ancient Roman secrets I'm giving away. Okay, here's another good one. As the market is rallying and going up, 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 and up, where's the volume, everybody? Forget this day. Throw that out. That is called the triple witching day. That is always going to see a very high volume regardless of whether the market goes up or down. It happens every 3 months. You can see here it's March 18th. You can see also here it's December 17th. It was September right around the 8th, 17th, 18th. And it's coming again probably June 18th or 19th as well. You'll always see huge volume spikes on triple witching days, so you have to discount that and throw that piece of data away. Other than that, though, there's not a whole lot of tall green bars down here, which is the volume as the market is rallying. That's dangerous. That's, what's that 4-letter word again? Risk, risky, and not something that you should be looking to take to the bank, everybody. It creates an environment that leaves the market very vulnerable to selling, which then kicked in here. It means there's not a lot of demand. In other words, prices went down, but this wasn't enough of a discount. Okay, Macy's had the merchandise on sale, but it wasn't marked down quite enough to create a line out the door, down the street, and around the block. There was no line. If there was, we would see prices going up and we would see the volume significantly higher than what it came in at. But what happens as soon as the sell-offs return? Bam, 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 bam. The selling comes back. The volume spikes. That's bearish, everybody. Again, that's how I knew the market was going to come back to these lows. Is it over? Just because it happened in days instead of months? Are we all done? No, we're not done. Again, easily could see a rally lasting a day or two, a week or two, even a month. Wouldn't be surprised. But I also wouldn't be surprised that if in a week or two, markets are below these points, heading to lower points unknown. That is a distinct and realistic possibility. So let's get into those two big. They're big, aren't they? Yes, they're definitely big. Let's get into these two big technology companies that reported earnings late yesterday. Google comes out. Looks like they missed their estimate. The stock has already been in a pretty significant downtrend, as you can see. Let's pull this back a little bit. And part of the problem developed right here. That was an earnings day. It was actually, again, they released their earnings in the late afternoons after the market closes. So the trading takes place the next morning. This is a time when they beat the earnings estimate. However, it wasn't enough. Yes, the stock did still post a 7% gain, but it couldn't hold its highs of the day. It couldn't even hold the open of the morning. It faded back from all of that. That is called a buying exhaustion gap. Okay? Buying exhaustion gap. Very next day, gap down at the open, closes the gap, but then continues. That's the start of the problem right there for Google. That's not the start of the problem for the technology world. That problem started a long time ago when interest rates started going higher. Plus, these guys have been running really since March of 2009. Expectations simply got unattainable and absolutely ridiculous. And obviously, Google is suggesting with the down day today that it still is ridiculous. Wouldn't fish in that pond. Move on. Microsoft, a little better result. However, look at this. This is something I wrote, a while ago. This has been on the chart since the end of March. As it was rallying, I put this up on the videos, put it up on the charts, roadblock of resistance. And keep in mind, this is when the stock was significantly higher than today, even after a pretty good rally up day from this morning. There's still a lot of overhead resistance in this company. This stock is not going to eclipse these highs anytime soon, let alone this triple barrier formation, this triple area of resistance way back here, dating in the fall and early winter of 2021. That is going to be a difficult area. Microsoft may not see those prices again for, several years. Again, let me repeat that. Microsoft may not see those prices again for several years. What about Apple? They have earnings tomorrow. Yes, tomorrow the sun will come out. The Apple will fall. Maybe not. They're also like a Microsoft. A lot of faith going into earnings with Apple. The company has been doing fairly well, but I would expect it to be something similar to Microsoft. It could gap up a little bit, trade pretty well, but there's a lot of overhead resistance, and there is a very high degree of doubt that Apple will eclipse the highs from January 4th of $183 a share anytime in the near future, intermediate future, or even the long-term future. Okay, how about Netflix? We know already the stock got bashed, beat up, and just demolished. After coming out with earnings, they dropped 34%, 35% in one day. Still going down. You believe that? The stock is still going down. Kind of ridiculous at this point. A little bit of an overshoot on the downside, overreaction. I wouldn't be surprised if in the next 3 or 4 or 5 days, Netflix managed to get a little bit of a rebound going, maybe into the low 200s or so. Can it come back in there and close that gap? Well, the low there, let's check that again. The low on that is $333 per share. So no, and how about this? No? Right. Did you know Netflix is down 73%? I believe 73% from its all-time high. And by the way, for those keeping score at home, that was not even 5 months ago. 4.5 months ago, it looks like. 5 months, not even. Netflix puts in a high, and it's down 73% from that high. This was one of the all-time favorite stocks. I mean, it's part of the FANG acronym, isn't it? Isn't it the N in FANG? Yeah, the market had fangs all right for it. Here's another FANG. Facebook. Woo! This guy's getting ready to be destroyed again too. Okay, their earnings are coming out later today. Decent probability that you get a bounce after the earnings. But if it does bounce and you're long Facebook, I would use that as an opportunity to get out of that stock, because over the next several months, whatever happens tomorrow or not, over the next several months, the stock should see lower prices than where it is at 172 right now. Again, tomorrow, earnings on Facebook could bounce. Sure, it is oversold. It has been getting beaten up. But I also wouldn't be surprised if you see it Google, where it just gets bashed and keeps going down. Nothing on that stock would surprise me. Whatever happens tomorrow, though, is kind of regardless. Over the next several months, the stock should see lower prices. And that is a summary of how I feel about the whole entire market overall. Yes, stocks in general could rally for a day, a week, or a month. However, if and when they do, I would use that as opportunities to lighten loads, get out, go to cash, get safe, protect yourself, because we are still in the early stages of this bear market. And it looks to me, with the early analysis, the early evidence so far, that this is not going to be a garden variety bear market. It looks to be something that has a little more teeth and the claws a little sharper points. Hey everybody, this has been your old buddy Romulus. Absolutely thrilled to have a chance, as usual, to share a little bit of time with you. I'm heading back to ancient Rome, because in ancient Rome, I don't have this crazy behavior in the markets. It's pretty calm, pretty steady. We're just enjoying a good spring campaign against some barbarians. I'll see you tomorrow. That's all for now.